Welcome to the Recruiter Startup Podcast. This is the Scale series. I'm joined today by Alex Elliott from Rise Investments and with our ever-present strategic advisor, marriage counsellor, and all-round recruitment genius, the one, the only, Andy Hallett. How are you both doing today, lads?
Andy's introduction was a lot more impressive than mine. And you got the business name wrong, Dualta. Rise Recruitment Ventures, just to clarify that point for everyone. But actually, I quite like being called a genius from time to time. It's never been said before, but just bear that in mind.
All right. Let's try that again. Okay.
No, let's not. Just it's good. Let's go with that.
Oh yeah, and hey, I didn't even get an intro.
Oh no. Okay. So
no. This is going to be warts and all. So you're not getting to read
warts and all.
Yeah.
Okay. You try a wee intro there on Alex.
So we're joined today by Mr. Alex Elliott from Rise Recruitment Ventures, who is taking his wealth of knowledge, having built a very successful business, which he then sold alongside a partner, is now taking that knowledge and empowering the future of the recruitment industry.
Wow!
I need to go and make some sales calls. I'm pumped.
There we go. She wouldn't make a sales call in a million years.
No. Fear of the phone.
Fear of the phone.
I don't believe that for a second. Okay.
Okay. Alex is on because he is the money man. And that's what we want to talk about today because we don't have enough. And we want to get loads. So how are you going to make us rich, Alex?
I think I should be asking you that question. How are you going to make yourselves rich? And how can we support you in that journey?
Excellent.
The Santa Barbara dream journey.
Okay, talk
Project Santa Barbara. Nice.
My little inspirational photo of myself that I keep on my desk. See that smile? That's a Santa Barbara. I'm buying my £1 million mansion smile.
Andy, thanks very much for your help over the last period of time. It's been an up and down few weeks with more ups than downs, but we've been through it. Can you give us a bit of an update as to where we're at with Scale from maybe the last time that we've spoken? Because the last episode, we did a bit of a rundown on the people that we were after. And without giving away any specific names.
Well, without giving away specific names, I think the really interesting thing was that we had the criteria of what we were looking for, and we've hired, and we've made our first 2 hires, and we're incredibly excited about what that's going to be. You sent me a WhatsApp, I think over the weekend, saying, I'm so excited about this. We ended up there by accident and it's fantastic. And I think when I replied back, I said, look, the location wasn't where we were looking, but it's not an accident we found those people, because when they became available, we knew what we were looking for. We had that criteria. So yeah, it was, we got there, and it's, it's very exciting actually. And having had the first meeting with those guys around what it is we're looking to achieve, you can really start to feel it come together.
Yeah.
And I think the other piece that excites me is, and Alex, thanks very much for letting me run stuff past you. Mm-hmm. And sometimes we always go for another voice, and then you usually just agree with Andy anyway. But it's good it's good for us to hear that reinforcement of what logical looks like outside of this madness of back and forth between myself and my lovely business partner. One of the things you said to me was nobody wants a jumbo sale. And if you're not going to be a niche technical specialist, you need to put a lot of thought around what that's going to look like. And that's what's we've ended up on Dublin. We've ended up with people that know each other, with a focus on technology-owned businesses.
Yeah.
That's fair to say? Yeah,
with a focus then even more on the Irish and sort of the New York markets and the synergies between them.
And then the other piece was, while we're a fully remote business, we're going to be a remote first business. And there's an important definition there. Being remote first means that you have access to an office. So the guys are going to have access to one of the leading co-working spaces in the Dublin city centre, and they will choose when they come in to do their meetings and all the rest and that. And I think that's really important for us, because we're going to try and, if we can build that community of workers in the one area, there'll be crossover between clients, there'll be a support net mechanism. It'll also allow us to hire people slightly more junior than we thought we were going to have to go for, because there'll be more chance for in-person learning. So that's a wee bit of an update of where we're at.
Very exciting. All kicking off next Wednesday, 17th of June.
Yeah, and you've been busy doing a lot of incorporation.
Oh my God, my head is like utterly with all the ops stuff. Like, I know we spoke about this, Alex, and like, again, when we were talking about not doing this jumbo sale and having it so that there was like some clear synergy and everything like that, that was really helpful, because I think I was, I'm pretty awesome, I like to think, but I was maybe overly optimistic about my time and abilities. So it's within now what is workable, but it is at that initial stage. It's like a learning curve, but it's really cool. I love it.
Sounds so exciting, guys. I think there's a real clarity to your vision now, which having worked through Andy, I think the strength of you guys is that you're very different, and that you've got that shared vision. But something we look for as a business when we're looking at potential investments is shared vision, shared values, but complementary skill set. And it's really cool that you guys have got that clearly. But you need to make sure that that's a strength. And the key, therefore, is to be able to have a mechanism where you can bounce ideas around and focus in on something and get a really shared vision of what the future looks like. Because you are different. You've got different worldviews and you look at things differently. And that is a strength, as long as say, you've got that mechanism to ensure that you're coming to good decisions which are evidence-based. And I know Andy's been working with you a lot on that.
A mechanism, hey? You've been called a lot worse, Andy.
I should have gone with sounding board. How's that, Andy? That's maybe a little bit less.
I mean, one of the things we've been looking at doing is shortening the decision-making process.
Yes.
And by having Project Santa Barbara, every time Dualta comes up with this idea and Charlotte says no, it used to be the argument just used to start. And actually now it's got a reference point. Does this get closer or not? And it was a war of attrition. Who would give in first? But actually now having the strategy just makes it clearer.
Yeah,
love that. And you know what you want to achieve, and you've both discussed that, and you've got a very clear understanding of your why. And I really enjoyed one of the first things I think you discussed. So I always listen to the podcast, and I really liked how one of the first things Andy spoke to you guys about was why. Yeah. Why are you doing this? So that the key is to match your personal why with your business why. And once you've got those two things matched, you've got a very clear understanding of what you have to build to be able to support your personal why. And then you can reverse engineer back from that, put a time scale in place, put milestones to hit those time. And you start to get that. We used to say, does it make the boat go faster? So exactly like, I can't quite get what Andy said, something very similar to that. So it was the same for us. Does this make the boat go faster or not? And I think I said to you guys, good strategy is saying no a lot. Yeah. That it is, because you've got to say no to lots of things that are really attractive and might work. But if it's not aligned with your actual long-term goal and vision, you shouldn't do it. And that's hard to do as an entrepreneur, because you want to do all the cool stuff that comes your way. But
I want to say yes to everything.
Yeah. And I usually say no to everything. So we're like now coming like this.
Before I jump into talking a bit more about the different types of investments, Andy, can you talk a little bit about what it is to think and act like a big business?
Yeah, so I'd welcome Alex's view on this, but one of the things so I did a few sort of due diligence exercises when I was at S3. So, S3 haven't ever acquired, but would acquire the right business if it added value to it. I'm sure. And we were active in the market in terms of looking at things. And what we often tended to find was that some of the businesses we looked at just weren't set up. They weren't integratable into our business, because they'd been run as a small business and never moved that. And the difficulty was that you almost need to get them to base cap before you can bring them into the business. And that was quite a shock for some of the owners. So some of the things that I'm working with with you guys is thinking and acting like a big business, because then if a sale does come along, are you ready? Are you packaged up, ready to go? Or does someone have to put a lot of work into you to get you into that shape? So, and at some point, most companies, a really good example is around accounting. So typically a small business will use cash-based accounting. So you will run on your bank balance, and that will be in your monthly figures. Now, normal, proper, big businesses that I'm used to working in will work on accruals-based accounting. So the P&L will be very different from the cash flow. And again, at some point, you're going to have to take that pain. So typically, if you're looking to potentially sell, someone's going to look at what your growth is. And they'll then have to go back and normalize your accounts to, what they would see as that growth, what the actual growth is when they put it into their language. So actually, you can take that pain now, and we can start accruals-based accounting, or you can do it in 7 years, Project Santa Monica, when you're trying to get a deal away, and someone's trying to work out what your actual growth rate is. So understanding how you'll be measured in the future by potentially, there's going to be a number of potential exits open to you. Okay, there's going to be trade sale, there's going to be PE, there's going to be management buyout. Potentially you guys just sit there and take the divvies, whatever. But in all of those circumstances, you're going to need to be run like a proper company.
Yeah.
Not a proper company. That's unfair. A bigger company.
Mm-hmm.
Yeah. And that's definitely, I know, something we've been working on, and a big transition for me. I suppose I've been, real kind of like just plug and fill up until now, and now it's actually taking that investment view to look at and go, okay, what are the things we're doing and setting up on the operations side? Like, is this going to stand the test of time when we grow and we're bigger, and versus kind of, oh, well, let's just shove this in and do it and we'll figure it out later, which does come a bit with a startup. But I think because we've got that benefit of having had the other business and done that, we already have a basis in which then we can grow from and edit things and take that sort of more investment style view when it comes to our setups and things.
And this is interesting because the other week we had a conversation with you, Alex, and you were asking us just about runway of cash. And I didn't say anything. I let Charlotte speak, but
Babble.
She, her communication in terms of what our runway was way beneath what it actually is, because she still looks at it from the old style of accounting, where it's like this is for anybody listening. This is me bear hugging you. So getting through all that stuff is really interesting. But one of the things you mentioned there, Andy, was a company to look at your growth rate. And that's really important. And that's why I think like the investment piece at some stage interests me, because we could get to 10, get to 20 maybe. Or like I see a lot of examples of companies that go to 10, go to 15, go back down to 9. And because they don't have that specific modeling in place into when to grow, how to grow, why to grow, and what that looks like from a back-end accounting piece. So let's start by talking about the different types of investment and money that are out there at the different levels. Alex, could you kind of run through how you would describe them?
Sure. So there's lots of different market segments. So I think first and foremost, like everything, you've got to understand what your vision is. You've got to be very clear with regards to what you want to achieve, and you've got to approach the market with that mindset, because some models naturally are going to be more suited to particular goals and aspirations than others. So I suppose, I don't know if at the bottom is the right way to describe it. So on the lower end, where individuals are looking to set up an independent business and probably not scale it, there's lots of opportunities out there to bring someone on board who are going to give you a platform, who are going to set up your website, who are maybe going to manage your payroll, and those organizations are going to take a percentage of your top end revenue. So that's probably that end. The other above that, or the other extreme end of that, you've got the larger players out there, which I call centralized models. So there's probably the most well-known one is run or owned by a pretty sort of well-known figure in the industry, and that is a large They've got about 30 businesses now, probably under their portfolio banner. Everything is centralized. You pay a reasonably high level of monthly subscription to use the services that they provide, and effectively you go into that business as one division of a much larger business. So you probably don't have a huge amount of control of the business that you're running, but you do have an awful lot of support and infrastructure from day one, as well as some really good executives who are going to support you with some of the strategic piece around it. You've also got angel investors. So angel investors are going to put in a decent amount of money for an equity position, and they're probably then going to offer you support on an ongoing basis and mentoring, which is reasonably unstructured, but these should be very credible recruitment business leaders or entrepreneurs who've achieved something in their career, ideally have also started, scaled, and again, ideally even exited the recruitment business previously. Again, there's lots of different types of angel investor out there, so I'd suggest you look at their backgrounds and see how what they've achieved fits with what you're looking to achieve most obviously. Rise Recruitment Ventures, we probably sit in between the angel investors and those larger, more centralized models. So we offer a tailored approach. We offer the entrepreneurs and the founders the opportunity to grow their own independent businesses rather than being grouped together. And on that basis, we're looking for business partnerships. We want business partners rather than individuals who come in and effectively don't really have any control of the business and their direction. So that feels a bit rambly. Does that give a give us a good overview?
Let me jump into some of that.
Charlotte laughed when I said that feels rambly, so now I know that was rambly. So,
I thought it was quite good.
Oh, there we go. It wasn't rambly. That's good.
I liked how you were like.
How we make that less rambly, or to use an Andyism, is unpack.
Unpack.
He likes to unpack things. What percentages of ownership or of revenue in terms of profit you have to give away at each levels of?
So the larger, the more centralized companies, look, you're going to give away the vast majority of your business. The bottom line, you are.
Put a number on it. Ballpark.
75 to 90%.
Oh.
Okay.
Oh.
All right. Yep.
So is that attractive to some individuals? Yes. Is that unattractive to some individuals? Definitely yes. So we as a business saw that, and we felt there was a real sweet spot to be investing in the types of individuals that on their own could grow good recruitment businesses, but with our support could grow great recruitment businesses. And look, for us, it's about, with us, can you do it bigger, faster, with less risk, and still get the benefit at the end of that, i.e. a larger number, whether that's exit value or a level of income that you're looking to generate through a lifestyle, etc., etc. So we looked at that opportunity, and I don't want to be too, those businesses offer an awful lot from a value perspective, and you've got to weigh up what it is you need as an entrepreneur and a founder to get you to the point where your business is going to be successful and is going to give you the things that you're looking to achieve on a personal level. That model is right for some people. Look, what we're looking to invest is individuals typically who can demonstrate that they're exceptional billers, but also they can demonstrate the ability to attract, train, develop, and retain high performance sales teams. Those individuals who very broadly have got those two skills, top billers, plus demonstrated that they can build and run high performance sales teams, are they the types of individuals at the level they're at who are going to probably give away 75 to 90% of the businesses? I suggest maybe not. So I think someone who's less experienced, who doesn't have that behind them, that experience, that model that centralized model might be more suitable to them, because they need more hands-on support around them to get them to the point where they're CEO material. That's not our sweet spot.
Need a job, right?
Yeah, sure. So that's not our sweet spot. Our sweet spot is those more senior level individuals who could do it on their own, but with our financial investment, and most importantly our time investment, we can really build momentum with those people and support them to achieve what they want to achieve, larger, faster, with less risk. And we're very active with our support, but at the same time, we're not going to hold people's hands, because the type of people we're investing in, we don't need to hold their hands. What we do need to do is support them strategically, operationally, and with cash and with financial management. So we want those hyper growth opportunities where we can really add value. That's our sweet spot as a business. And then you've got angel investors who again can be the right angel investor. That's a really attractive option. You're probably not going to get as much hand-on support as you would with us, but depending upon the individual and their background, I think they offer an awful lot of value as well, depending upon their market background, what they've achieved from a business perspective. You know, there's some really good people out there in that space as well.
When you were
They're probably not going to invest as much money, and that's not always true. There's some out there that will invest a lot of money, who've been very successful. There's others out there who maybe haven't exited their own business, therefore don't have as much capital themselves, so they'll invest a smaller amount. But naturally, with that comes a lower level of equity on their part.
So just with this, and this is obviously going to edit, obviously, business to business, person to person, situation to situation, but when is the optimum time to be bringing investment into your business?
I think that's purely based upon what your vision is. So what do you want to achieve and by when? And if we brought investment in now, are we going to fast track that? Is it going to get us there quicker, or is it going to make something bigger, but in the time scale that we had envisioned? What support do we need strategically, operationally? So I think it's a very broad question, which I don't think there's a one size fits all answer to.
Yeah, because I'm wondering in regards to obviously your positioning, and I know we spoke about this briefly before, like when you're going and you're sort of figuring out what it is that you need to help accelerate that vision that you want to achieve, you know, when you're asking the whole sort of how much do you give equity wise, when we go back to those percentages, how much do you give for what you get? Obviously there's going to be like that fine line of when you go for investment, that if you've got, say, more kind of demonstrative kind of this is what we can do, surely you're going to be in a better position when it comes to negotiating on the percentages than if it's I haven't done this yet, but I have an awesome vision. This is going to be how I'm going to achieve it. And that might still be of interest, but obviously you've not got as much to leverage.
So that question is, what metrics do you use to decide?
So, risk and reward are inversely, I don't know if I'm describing this right, they're inversely related, right? So that the higher the risk, the more reward an investor is going to expect effectively by risking their capital and their time in that opportunity. So I agree totally. The more established you are, the stronger position you're in to retain equity. Look, this sounds a little bit cheesy, but the first thing I'm going to say is the important thing is to focus in on value generation rather than equity level. And it's that cheesy thing about I'd rather have 50% of something really, really big than 100% of something really, really small. So that's something I'm always very keen to sort of, again, although it sounds self-serving, because it kind of is in a way, it's true. The metrics that you have to think about are how much is the total investment value? How much are the investors putting in versus how much are the founders putting in? So from a startup perspective, is if the founders are putting capital of their own in, what's their proportion compared to the total investment value? We support founders with salary as well. So obviously that's advantageous to a lot of people. They're starting up a business, but they've got guaranteed income from a startup perspective. So what are their salary expectations for the first 3 years? How much do they want to earn? How are they going to be remunerated? Is that salary? Is that a high salary? Is it with commission? Is it a mixture of low salary with dividends, with commission? So how they're remunerated is a really important thing to take into consideration. There's loads of levers that you pull, and depending upon which lever you pull, it will produce a different outcome. For me, the key is to be really transparent about what those levers are, to say these are our expectations as investors, these are your expectations as founders. Let's now pull some of those levers and see what comes out the other end. And let's also make sure that we're really, really focused on how we're going to get you to your end goal objective together, and how we're going to add value throughout that process and support you to get there, ideally bigger, quicker, with less risk. So in answer to your question, there are a number of metrics. The key is to be really transparent about those. Say that if you want a higher level of income over your first 3 years, that's going to impact your level of equity. If you don't want to put in much money at the beginning, that's going to impact your level of equity, etc., etc.
Yeah.
Andy?
I think that's absolutely spot on. I mean, I think I would always look at, the investment decision is based around where it gets you. And to go back to that point, it's a calculation. So, at any given point, if we take investment now, will the enterprise be worth more in the end? And Alex talked about value, and absolutely, 80%. I mean, we talked about the big business thing. It may well be that 25% that person retains. They've been helped by that company build them into a much bigger business. That might still create them more value than 100% of where they just would have got to on their own. So for me, it's just a calculation, and you won't know the answer, but it's your best view of what that calculation gives you. So, if you take, at any given point, I think what's really clear is why you're taking investment. So what it gives you. So it might, Alex has talked about, it might give you people around you. So it might, always think about money isn't always equal. You've got dumb money and smart money. So with this smart money, can that de-risk it for us as well? Because they have to make it work. So understand why you're taking it and what you're going to spend that investment on and what that's going to do. I think certainly in the, I've sort of seen in outside of the recruitment world, in the tech world, investment's almost a vanity thing. People take it to get some super valuation, and it's almost the VCs expect you to spend it quickly and quickly and quickly, and so to get onto the next round to get your increased enhanced valuation. And luckily, I think recruitment is actually an industry where you actually have to demonstrate, you're actually a proper business. You're going to have to make some money as opposed to some big SaaS corporation. But I think understanding when you take the money, only taking what you need when you need it, and being really clear why is probably the advice that I'd give.
And Alex, having scaled and sold a large business, that point of dealing with the PE houses, how do you foresee that relationship working with your company and your company's investments? Have you got certain amount of private equity people that you guys will be like building relationships with in order to help your founders?
First and foremost, I think you need that technical expertise in the business. So on our board sits the guy who sold our business for us, who worked for a M&A business. So we've got that expertise in house. But 100%, it's important as you're getting to a certain point that you want to be able to have that network effect of knowing who the right people to speak to are, who would be interested in looking at high value opportunities within the recruitment sector. So yes, that is an important consideration. It's something that, again, that's the difference maybe between an angel investor who's going to be, it's going to be less structured, the support, and the more centralized model, whereas I'm sure those guys do it. But again, that's why we feel that we can offer a really tailored package, which gets the best parts of what an angel investor will offer, but also the best parts of what that centralized model will offer as well.
And Andy, in terms of like due diligence from an operational perspective, what type of things do you see people doing wrong who are quite large and are looking to get to the next stage?
I think it's difficult. It's difficult in every company, but realizing as you scale, you do need to invest in operations, and actually not getting your operations right will give you growing pains. So, and typically if your growth is your growth can be easy or your growth can be tough. And again, looking at, I don't know if Alex agrees, but if you're looking at buying a business, you're looking at, how effective, if we added 50% revenue into this business, how would that convert? And actually the slicker your operations are, because typically the big PE firms, will come in and look at how they can effectively ratchet up that business to deliver greater profits with what it's got. So how efficient you are will potentially help you in any sale, I'd imagine. But I think the term I've used before is match fit. Are your operations match fit? If someone else came in, could they take you over? If they're not, then you will pay. You will be discounted as a result.
Yeah.
Yeah, we're determined to create something outside of ourselves this time. having ran a lifestyle business, business books will tell you that you're actually a freelancer if you haven't created a highly paid freelancer. Seth Godin has that in the startup series. If you haven't created something that's outside of your direct influence. And the other useful thing I've heard from Tim Ferriss was, he said every year you should take more time out of your business to a point that it can run 3 months independent of yourself.
I could agree more. And look, that's the different stages you go through, right? So 100%, the challenges to scaling are strategy, execution, people and cash. If you think about those 4 pillars and you work on them, but the way that we operate is we talk about a mountain analogy. So we say you always want to keep your eye on the top of the mountain, but then the key is not to say, right, what's the journey from the bottom of the mountain all the way to the top? Let's map it out. Actually, what you do is you understand where the peak of the mountain is, but you break the mountain down into its different plateaus. And then there might be 5 or 6 plateaus. So our model is that we have a growth strategy planning process where we support founders almost like 6 mini business plans as they grow and scale their business, because most recruitment businesses go through the exact same stages of growth. First and foremost, it's about building a war chest. It's about building some brand equity. It's about generating repeat business. It's about predictable revenue and building up your cash flow and becoming a strong business from a financial perspective. The next stage is to start hiring and become a founder-led business. So understanding what the business looks like. You can only manage so many people on your own as founders. So the next stage is to turn the business into a manager-led business where you're identifying those high potential people, giving them the necessary training and development and support for them to become high performance managers. And then they manage the people below them and you manage the managers. Then it's about becoming a director-led business. And then it's about becoming a board-led business. So again, it's about making sure that you've got all those plateaus right. At the end of that, hopefully you get to the point where really you sit on board, you kind of sign off strategic decisions, and that's it. And that's a nice position to be in. My business partner and I, we were in the we exited our business, I think, 2 months after the sale went through. And that 2 months, we didn't really do anything. We were just there in case they needed us in the background. And the reason for that was it was a board-led business. We'd gone through those different stages of growth and we'd got to the point where we didn't do a huge amount, bottom line.
It's interesting when you talk about the war chest thing, because I think for us on the Rec2Rec side, seeing, like, we see a lot of businesses and we do see a lot of startups, and you know, you've always got that thing when you build a business, isn't it, when you want to try and sell it, that you do need that recurring predictable revenue, which traditionally in recruitment would kind of be contract, if we just say that. But a lot of people become, obviously, we've got to get the war chest, we've got to build the war chest, we've got to build it up. But it's interesting, we've seen a lot of startups that get stuck in the perm world of building this war chest and then find it exceptionally difficult to bring in the contract element. And I suppose we're conscious of with our business is we definitely need to build the war chest. We've got that, that's a key stage. But for me, when we look at those strategic hires and we, you know, have that strategy at the end of what we want and the vision and everything like that, that has been quite useful now because, you know, with the people we've identified, very happy with that. But when we're keeping our eye out for the next identification, I'm already, for me, like, I really want it to be contract because I don't want to find us in this thing of 3 years down the track, we've got this fully perm business and then we're trying to pull it in, you know, so it's kind of, it's making those sort of decisions, I suppose, isn't it?
It is, and it's not just about money in the bank. It's also about, so we were talking earlier about having your accounts in order, but what do you need to scale a business? You need data, and you need to be able to make evidence-based decisions, and that's as basic as getting your CRM stuff right. So if you don't have the volume of if you can't genuinely measure the volume of opportunities coming into your business, what your close rate is, what your conversion ratios are, how do you structure your hiring plan? It's very, very difficult, right? Because effectively what you're doing is guessing with regards to the market opportunity based in different regional areas, international spaces, whatever it might be, within certain verticals and niches. So what you need to do is start building up data, which is going to support you to make those decisions. Yes, cash in the bank is important, but it's all well and good having loads of cash, but you could overhire. Even with loads of cash in the bank, if you just start hiring willy-nilly, and take on 6 people in the space of a few months, all of a sudden you've got to put those people on desks where they can start to either deliver on the opportunities already coming into the business or actually go out and win business. So again, you've got to have a gap between hiring them, training and developing them up, and getting them to a level where they can actually become income producing themselves. So what am I saying? You need lots and lots of data in your business early on to be able to justify making good evidence-based decisions. Otherwise, you're just guessing, and you make mistakes that way. I've certainly done that. I've gone with gut. I've overhired, as an example. I haven't thought about, right, this is my beachhead strategy. This is where my key market is. What's the size of that opportunity? At what point are we going to have to move into another patch, whether that's another vertical, another niche, or another geographical area? I haven't maybe structured the hiring plan strategically enough to fit with the evidence and the data in the business. It gives you the opportunity to look ahead and understand what you need to do.
Given you know that now, talk to me about the structure of how you decide on an investment and what that interview process looks like. Let's call it an interview.
So ours is quite a long process, but very, very, look, let me describe it differently. You spoke last week about internal hiring, right? And building a candidate scorecard. We do the exact same thing. Great practice to have. It really makes sure you're super focused on what's important. The 5 very broad categories we look at are the people, the market, the plan, the financials, and the deal structure. So our process is built around analysing those 4 categories as we go through. So first and foremost, it's about speaking to the individuals. Then it's then going through the normal interview process that you'd go through if you're hiring someone internally into your business, and understanding everything you can about them as individuals. Also, understanding how they fit together. What's your dynamic assessment, ideally, of a partnership? Because we like partnerships, we love that, and we think you're probably a great example of that. Then you need to start thinking about the market. So you need to go through the process of understanding the market in depth so that you can offer value from a strategic perspective. Then you need to look at the deal structure. So you just work your way through those different things. So it's quite a long process. There's no getting around that. But again, it has to be, because we want to make evidence-based decisions, and we want to be able to, we wouldn't invest in people unless we could categorically say, we know how we're going to add value to support these guys to get to their vision. Because if you don't do that, if you can't do that, well, we're only investing in a small number of opportunities a year. We need to make sure they're the right opportunities where we add value. So that's why the process is so methodical.
And I think as well, on the flip side, from like a recruitment entrepreneur founder, if you're going into investment with someone, you have to take that long-term view that it's going to be the right partnership, because the last thing you want to do is just make a grab for cash, it not be the right partnership, and it all be not right. Do you get what I mean? So it's equally important on both sides to know that collaboration is going to be really effective in pushing things forwards, and you're way better to invest more time in that process with each other to know it's right.
You have to, like, that chemistry piece is so important. And it's not just chemistry, it's mutual value. We are not the cheapest option out there, far from it, because we offer a huge amount of value. We've got a team of A players, we've got an FD, we've got a director of operations, and we've got 2 guys who started, scaled, and exited their own business. So we've got all of those touch points, we've got all of that knowledge within our business, but we're still great value because of what we offer. So again, it's making sure that both parties appreciate the value the other are bringing to the table. That's an important piece for us.
Andy, anything to finish this up?
I think Alex's point there, right at the very end, was spot on. It's that thing of value versus cost, and I tend to find that in the consulting business. You've got 2 types of people: someone that look at what the consulting can give them, and someone just look at what it's costing them. And actually, if you get hung up on the cost, then you're probably not the sort of person that should really be speaking to these guys, because of the value that they'll give. It might cost you a bit more, but you might get a hell of a lot more on the upside. So I really like to sort of finish that. That value versus cost proposition is so important.
Okay, fantastic. Anything to finish this up?
No, I'm just super pumped. Like, I'm so excited. I'm so excited now that we're literally like a week away from like launch kind of thing. It's that real, I don't know, that excitement phase where you just feel like you're fit to burst.
It was like,
have you really called it Project Santa Barbara?
I hope so. That's what
I
I'm
love that. That sounds awesome. No, that sounds incredible. That sounds really cool. I think you need a picture of the house as well. Go true vision board. Get an actual picture of the type of house you want.
Every time there's ever an issue, does this get you closer or further away to Santa Barbara?
Yeah,
and
that's it.
It's just made that decision making so much easier, and just increased our culture of no surprises. So yeah, I mean, does it or doesn't it?
Okay, guys. Thanks so much.
Yeah, thank
Alex,
you.
Andy, Charlotte. It's been great as usual. Hopefully, this has provided a tremendous amount of value to anybody who's going through this journey. My head's kind of ready to explode with all the stuff that you're going to have to put together.
But I'm looking forward to it. So thanks so much, guys.
Absolute pleasure. Really good to talk.
Thanks.